In this video, we're going to talk about Fubotv, trading under the ticker symbol FUBO. Fubo is a streaming platform specialized in sports and entertainment and aims to take a profit from the ongoing cord-cutting movements as well as the ongoing situation to benefit from increased viewership. Long story short, the company is making a loss at the moment, but a lot of financial data have confirmed Fubo's momentum during the first quarter of 2021. Now, keep in mind that this period covers the first 3 months of that year, and many people were staying at home. So it will be interesting to see whether that tendency can maintain itself in the years that follow. We may also see the sports gaming business taking an increasingly important share in the revenue since it has been one of the diversification routes that the company has chosen. This is where that Fubo may benefit from new influx of subscribers in the years to come, especially for those looking for sports content. For streaming services, the money is either in the subscription fees or in the people paying the subscription fees. From what Fubo has released in its financial data, it seems like the subscription fees allows it to stay afloat, in other words, to pay the fixed expense, and the gaming subsidiaries will allow it to yield a profit. The trading volume of Fubotv has recently been 4.8 million shares, compared to an average volume of 8.2 million shares. Over the previous 52-week period, its price fluctuated between $13.18 and $57.47. The market cap of Fubotv is currently at $2 billion, compared to the enterprise value of $3.3 billion. The difference between the market cap and the enterprise value is the premium or discount financial market is willing to allocate to the company, based on its current fundamentals, leverage, asset composition, and the mood of financial market participants. Some of the examples of the impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn may negatively impact its profitability and solvency. Another element to understand is the asset composition of many companies. It is especially true for the growth-type companies. For many of those, one of the most significant assets they own is the goodwill. Goodwill is the expectation the market has for the company regarding its capacity to generate more profit or more growth than other companies, partially because it may have a good management, stronger brand recognition, stronger following online, and so on. However, it's often the reason why some companies may be perceived to be trading at a discount, because the market cap is lower than the enterprise value, which is the value the market gives to its assets once the debts are paid off. In comparison to its historical price fluctuations, the stock is 7% higher than the 1-month low, the 3-month low, and the 1-year low. In terms of the options market, which often gives a hint of the market sentiment on where the stock price is likely going to head toward, the implied volatility is 86% compared to a historical volatility of 71%. The put-call option ratio is currently at 38%. The most recent volume of options traded has been 14,000 contracts within a day, compared to the 30-day average of 46,000. In terms of the open interest, the most recent volume of open interest has been 332,000 contracts, compared to a 30-day average of 392,000 contracts. Now, about the shareholder structure, institutional shareholders hold about 41.7% of its outstanding shares. The biggest shareholders include Vanguard, BlackRock, and iShares. The relevance of the shareholder structure is important here to determine whether you should be holding the stock long-term or to view it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Of course, there are a lot of exceptions from what I said above, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just as a short-term trade. So in this regard, Fubo is perceived as a sound long-term investment, at least by the institutional shareholders. Let's also look at the short interest present in the stock, which is the amount of position that aims to profit if the price falls lower. Sometimes there are significant short interest in the total volume, which could be a sign that there is an organized shorting operation going on, like what's going on with GameStop or AMC. The short interest in Fubo at the moment is 15% of the total float, or 36% of the dark pool transactions. Now, let's take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. Oscillators are showing 1 sell, 7 neutral, and 3 buys. Overall, the tendency suggested by oscillators is to buy. The moving averages of the past price actions show 13 sell, 1 neutral, and 1 buy, with an overall tendency to strong sell. The moving average can be used to determine if the stock is overbought or oversold at the moment, compared to its previous price fluctuations, which can be used to see if your trade is sufficiently well timed. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $10.81, $13.31, and $14.86. For the resistance levels, they are $19.72, $21.42, and $23.93. Looking at Fubo TV from both a corporate and equity perspective, Fubo is a decent company with a lot of potentials and is playing on the leading edge of regulations, which expects more room for growth. With that being said, many also perceive Fubo as a speculative trade back in 2020 and acting as if everyone was knowingly playing a game of hot potato. Market participants are looking to buy Fubo if they believe that the company has more room to grow in the years to come, and that it'll manage to keep its gains realized during the 2020 and early 2021 era. Another factor is whether the cord-cutting movement will amplify in the years to come and benefit Fubo as the sports streaming platform without requiring cable network contracts grow. In December of 2021, Fubo has announced that it's going to launch Fubo Gaming, a subsidiary based and operating from Arizona. This platform is launched with the Action community, which also expands Fubo Gaming's presence to Iowa. All these efforts are some of the steps taken to not only increase Fubo's revenue streams, but to especially give investors the outside image that a company is growing, at least rhetorically. Whether they can manage to eventually generate profits from those events or efforts, I believe that we still have to be a bit more patient, and to understand that so far, a lot of the phenomena aim to maintain the image of a dynamic and growing company regardless whether the substance is necessarily there. In terms of its price action, the overall trend seems to be trending up. Now, so far I've been pretty lenient with Fubo TV because I believe that in the long term there are real reasons why the stock may be appealing. Now, the actual current reality is that so far the price action is pretty sluggish. The performance from the past semester of 2021 to nowadays has been very lackluster. The stock has fallen by more than 50% compared to its peak, or relative peak I shall say, back in September of 2021. I believe that this sell-off is caused by the change of investors' focus, which has caused the company to eventually lose a lot of its value from the financial markets. The stock has recovered a significant chunk of its previous losses, so both the temptation of pullbacks and coupled with the shareholders' capital flight to other locations accelerated this phenomenon. But my recommendation is to keep Fubo on your watch list, although the entry point may not be for right now. The correction is still undergoing and we still need to look for some support levels. I would suggest to keep a maximum exposure of 1% of the portfolio in Fubo and keep a profit target between 30 to 50%. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.